Question 61. John Pham, a commodities trader, has analyzed the forward prices of crude oil contracts and realized that there might be an arbitrage profit present in oil futures contracts. The spot price for 1 barrel of crude oil is 62.57, and the 6-month futures contract is quoted at 65.35 per barrel. If the risk-free rate is 5%, then the arbitrage profit for trading 1 crude oil futures contract is closest to. So we're looking at 6 months futures contracts, and essentially we'll know if there's an arbitrage profit if we can borrow and buy one barrel of oil for 62.5. So if we can borrow at 5% for 6 months, and our interest plus buying 1 barrel of oil right now is less than the amount we can lock in selling that in the future, that's essentially making this a risk-free trade. So what that looks like is we're going to take that 62.57 that we'd be borrowing, and then we're going to multiply that by 0.05 continuously compounded by 0.5, since it's a 6-month, not a whole year futures contract. And that gives us 64.1540. So that's essentially the total cost of us putting on this trade. So we need to buy the barrel of oil, and then we also need to pay interest, which is what we're calculating here. And then we subtract that from our, by going short this, we're locking in the price that we can sell that oil for in the future. So if we go short that, we're locking in a sell price of 65.35. The cost of this part is 64.15, so we can earn $1.2 per barrel of oil. And that's going to lead us to answer B. Question 62. Susie Lee, FRM, a risk analyst, has recently left quality consultation firm to join its competitor, Horizon Consultants. Lee was respected at Quality Consultation for her superior knowledge of quantitative analysis and for building dynamic risk models. Since Lee was solely responsible for building these risk models, she took all of her models to her new employer. Susie Lee's action. A is not a violation because she is the sole developer of the risk models. We can rule that out. If you develop something under your employer, that is your employer's property or intellectual property. Unless she had permission from her employer to take them, she should not have taken it. B is a violation because these risk models are the confidential property of her former employer. That sounds like it could be our answer. Let's make sure we can rule out D and C. Is not a violation because she already left the firm. It is not answerable to her former employer. She took them presumably while she was still at the firm and then to the new employer, because she would have needed to have access to them while she was still at the employer. And then D is a violation as she has left Quality Consultant to join its competitor. Leaving your firm is not a violation, but taking that confidential property is. So we go with answer B. Question 63. The following sample autocorrelation estimates are obtained using 333 data points. So we've got lag 1, 2, and 3 in those coefficients. And then the value of the Ljung box Q statistic is closest to. So let me pull in that formula we're going to use. So we're going to be using n plus 2. So that's going to be 333 for our n, and then n plus 2 will be 335. Then we're going to do the sum. And the P here is going to be those coefficients. And so we're going to be doing each of these different values. So it's going to be 0.12 squared, and then it's going to be divided by n minus j. So j is going to be the lag, and n will be our 333. So we'll have 0.12 squared divided by 333 minus 1, so 332, and then kind of so on down the line. And we'll sum all those up and do out the math. And here's what that ends up looking like. As mentioned again, to reiterate, that P is going to be this coefficient, and then the lag will be that J. So we'll do 333 minus 1 to get 332. And then we just do that on down the line, and then we'll multiply all this out, and that brings us to 17.32, which is answer A. Question 64. What is most likely the definition of a special purpose vehicle? And just remember those special purpose vehicles. It's pretty common to use in like a asset-backed security or other securitized debt, where you're pooling together a bunch of loans and then you're putting those that pool of loans into this special purpose vehicle, where investors can then buy into that and receive those cash flows. So a subsidiary company with an asset liability structure and legal status that makes its obligations secure even if the parent company goes bankrupt. So this does sound like the proper definition of an SPV. We will make sure we can rule out B, C, and D here, but this sounds good. Answer B, a type of asset-backed security that is secured by a mortgage or collection of mortgages. So this is going to be the definition of a mortgage-backed security. And an SPV could hold these, but this is not the definition of an SPV. C, a structured financial product that pools together cash flow generating assets and repackages this asset pool into discrete tranches that can be sold to investors. This is going to be the definition of a CDO. And then D, a subsidiary that reduces the effects of prepayment risk, the risk that the principal amount will be paid ahead of schedule. This is going to be the definition of a PAC tranche, which could be a tranche of the debt described in C here, but it's not going to be the definition of an SPV. So we'll go with answer A. Question 65. An analyst just finalized his presentation to the investment committee of an investment bank, where he showed his calculation of the price of a 1-year European put option on stocks of one of the local companies using a binomial tree model. He used the following inputs. So we've got stock price, volatility, strike, and risk-free rate. A few hours later, he decided to revise the calculations and found a mistake in the calculation of the stock price annual volatility. How will the price of the European put option change if the correct annual price volatility is 50% instead of 30%? So we're going to be doing two calculations here. We're going to be using this binomial tree model, which again is we need to find the value of the option at time 0. We're going to calculate the value of it one period from now using the 30% volatility and then also the 50% volatility. And then once we have these values up here, we can take the average of those based on the probability of those moves and then bring that back to the present value discounted by risk-free rate. All right, so let's dive in. I'm going to make quite a bit of room down here, so I have room to pull everything in. So first thing we need to do is calculate that probability of an up move, which is going to be our risk-free rate at the continuously compounded amount. And then we're going to subtract the magnitude of down move, which is going to be e to the minus 0.3 for that 30% vol. And then bring those same variables down here. So magnitude of up move will be e to the positive 30% vol. And as we're going through this, we're basically doing this for the 30% vol, and then we're going to do the same thing for 50%. Keep in mind. So from here, we have that probability of up move. So next we need to figure out the up move price based on the 30% volatility magnitude. So up move under 30% is 134.99. Since we're doing a put option, we're going to take that strike price and we're going to subtract the value of the underlying to get our value. So we're going to be negative 44.99. Since it's negative, we will just not exercise this option. And so it'll just be worthless essentially at 0. And then for down move, we're going to do, for a 30% volatility down move, we get 74.08. So that value ends up being a little under $16 for that put. So the price of the option, these are the at time T1 now. So we've got 0 and 15.92. So the probability of the option being 0 is that up move probability of 0.4756. And then we add that to the probability of 1 minus 0.4756 having this option value here. And then this here is going to be discounting back at that risk-free rate, which brings us to $8.10. So from here, we're essentially going to do the same thing. And I'll go through this a little quicker since it's the same thing. You're just inserting the 50% volatility in all the different spots. So we get a lower up move probability at 0.4068. Our up move price ends up at almost 165. Again, this is a negative value, so we will just count this as a 0 since we won't exercise this option. Our down move becomes more valuable at 29.35. And so the price of the option at time t, again, we're going to use those probabilities, multiply by the values that we got, and then discount that back at the risk-free rate. We get 16.9. So the value going from 50% vol to 30% vol, it increased the value, value change, this should be 8.1. So we have a 8.8%, or not percent, $8.8 increase in value by increasing that vol. So that's going to bring us to answer A. Question 66. Jason Briggs purchased a 3-month call option by paying USD 8 cents. The exercise price of the option is 1.32, while the underlying is priced at USD 1.35. Is the option currently in the money, and at what price will the break even occur? So to be in the money on a call option, our strike price needs to be below what the current price is, or what the underlying is currently trading at. So we do meet that criteria. So our strike is 132, and the underlying is above that at 135. So that means we're in the money. Essentially, we're in the money because we're going to make money. So we are in the money. Oh, it gives us, in the money, no. So we can rule out A. In the money, yes, could be B. In the money, yes, could be C. In the money, no, we can rule out D. And then at what price will the break even occur? So the break even is pretty straightforward. That's just going to be our strike price plus the premium we pay. So our strike at 132, premium is 0.08. So we will break even once the underlying is at $1.40. Which corresponds right here with answer B. Question 67. A trader is interested in a strategy in which he purchases an option with the strike price of USD 92 that expires in April. She then invests in another option that starts in April and expires in July. This option will have a strike price equal to the price of the underlying in April. The series of such options is called a cliquet option. So this is going to be our answer, and it describes essentially what we're talking about up here. So it's going to be a series of consecutive forward start options. So we have this option down here, which is options starting at future dates. So we have one option with strike price that expires in April. We don't know what the future is there, but we're basically laddering these. So we have this one expiring in April, and then we have starting in April. So that's going to be in the future, and then expires in July. So it's essentially 2 or more forward start options in the future. So a forward start option is going to be an option that starts at a specified date in the future. But we can rule that out since there's more than one option here. A gap option is going to be a type of binary option where the strike price is different than the payoff strike, which no mention of that here. And then spiral futures option, this is just kind of thrown in there to make things wacky and throw things off. It's not an actual thing. So we will stick with A, cliquet option. Question 68. According to the capital asset pricing model, which of the following risks should an investor be compensated for? So we've got 1, unsystematic risk, 2, asset-specific risk, or 3, systematic risk. And then 1 only, 3 only, 1 and 2 only, or 1 and 3 only. So according to CAPM, the investor should only be compensated for systematic risk, or beta essentially. Since CAPM assumes that there's no transaction costs, an investor can diversify free of cost. The investor does not need to be compensated for diversifiable risks, essentially unsystematic or asset-specific risks. So it'll be 3 only, which is going to be answer B. Question 69. A portfolio consists of 3 bonds, and each bond has a 1-year default probability of 10%. The event of default for each of the bonds is independent. What is the probability of exactly one bond defaulting over the next year? So we're going to be using this big long formula here to calculate this answer. And I shouldn't say big long, but essentially this is the main formula, and here's what it simplifies to. So we're going to have n over k times n minus k. So k is going to be the number of bonds that the probability of one bond defaulting over the next year, and then our n is going to be the number of bonds, so 3. So it ends up being 3 over 1 times 2, and then multiplied by p, which is going to be the probability of default, to the k, and the k is going to be again that 1, so the probability of one bond defaulting, and then we're going to multiply that by 1 minus p, which is going to be the inverse, which would be 0.9, and then to the n minus k, which is going to be that 3 minus 1, so that gives us 2. And when we multiply all this out, put everything in the calculator, gives us 0.243, which corresponds right here with the answer A. Question 70, a risk analyst uses the EWMA model with lambda equal to 0.85 to carry out an update of correlation and covariance rates. On day n-1, the observed percentage changes for variables x and y are 5% and 3% respectively. Historical data puts the correlation estimate between x and y at 0.66 on day n-1. If the estimated standard deviations on day n-1 are 2.9% and 3.5% for x and y respectively, then which of the following is closest to the new estimate of covariance between x and y on day n? So we've got a lot of information here, and so we're essentially going to be using n-1 data, so yesterday's data, to kind of estimate covariance today. So the covariance today, we're given all these variables. So our lambda we're given at 0.85, and then we're given that here, and then our x minus 1 is going to be this this n-1% of changes. So we've got x at 5%, so that'll be plugged in right here. And then our y is going to be 3%. That'll be plugged in right here. And so we're given everything except for covariance n-1. However, we are given everything we need to do to calculate the covariance of n-1, since that formula is right here, which is going to be the correlation, which we're given at 0.66. So that'll get plugged in there. And then the standard deviation of x and standard deviation of y. So we're given standard deviation of those two right here, 2.9 and 3.5%. So we will multiply those three things together as we just walked through, and that gives us 0.0006699. So now we have this variable here, and from there, we're just going to plug in everything. So we've got lambda, which we bring down 0.85. We bring this over here. And then plus 0.15, which is going to be that lambda minus 1, or 1 minus lambda, and then 0.05 and 0.03, which we talked about being right up here. And that brings us to an answer of 0.0008, which is the new covariance estimate, and that will be answer B.